good day, everyone, and thank you for joining Group 11's Zoomside chat on the future of the U.S. economy with Dr. Christopher Thornberg and Dovi Frances. Before we get started, I just want to review a few technical items. At the bottom of your Zoom viewing screen, you will see audio settings and Q&A. If you're logged in via computer, please click on audio settings and ensure your preferred audio device is selected so you can listen to today's audio. Questions that were submitted in advance to this discussion have been embedded into the discussion and the Q&A portion. Should you have a question throughout the presentation, please use the Q&A function. We will do our best to address any further questions submitted. A couple things to note: all participant audio is set to listen only, and this event is being recorded. And without further delay, I'll be handing things over to our host and moderator, Dovi Frances.
Thank you, Ryan. And good morning to over 150 limited partners, family office executives, tech investors, founders, and real estate investors who chose to join us today. This event is also broadcasted on our social media pages. In fact, it's also broadcasted on mine. So I expect we'll have hundreds of people tuning in today to get some perspective on the US and global economy. My name, to those of you who don't know me, my name is Dovi Frances, and I'm the founding partner of Group 11. Group 11 is a top decile performing venture capital firm focusing on the financial technology sector. We invest in category defining companies and entrepreneurs who are redefining the financial landscape. While many of our peers have been hunkered down in their bunkers and closed for business over the last few weeks, we have taken advantage of this crisis to double down on our existing portfolio companies by adding value vis-a-vis making client introductions, providing additional capital and guidance as needed, as well as doubling down on our community, on you, by making new investments, sharing thought-provoking pieces, and hosting events such as this one. I have asked my dear friend and former UC Anderson professor, Dr. Christopher Thornberg, to join us today and provide some clarity and share his views on what the future holds for the US economy and what it means for all of us. A little bit about Dr. Thornberg. He founded Beacon Economics in 2006, and under his leadership, the firm has become one of the most respected research organizations in California, serving public and private sector clients across the United States. He's an expert in economic and revenue forecasting, regional economics, economic policy, the labor and real estate markets. He became nationally known for forecasting the subprime mortgage market crash that began in 2007, and was one of the few economists who, to record, who predicted the global economic recession that followed. He holds a PhD in business economics from the UC Anderson School of Business, and I'm really delighted to have him here today as our guest. With that, before I hand it off to Chris, just one quick comment on the session and the structure of the session. It's basically split to two. The first part is about 35 minutes where Chris just talks about how he views the markets globally and of course in the US. And the second part is your questions. You have submitted dozens of questions through our portal, and we'll try to address some of them. We condensed it to about 8 themes, about 8 things that you guys were extremely passionate about and were intrigued with, and we'll address those. If you have any additional questions you feel like we're not responding to, please use the chat box feature and add them over there. And with that, Mr. Thornberg, my friend, the stage is yours.
Thank you very much, Dovi. I appreciate that. And good morning, everybody. Happy Good Friday to all of you out there right now. To say the least, these are intriguing times. There is a lot going on. And I'll tell you, as somebody who spent a whole bunch of years telling everybody that things were just fine, I have slowly found myself, of course, like many forecasting organizations, scrambling to understand exactly what is going on today. This is a truly unprecedented circumstance, and in as much as we're dealing with a shock to the economy that is not only extremely large, but also incredibly unique. And I would tell you that a lot of the folks out there who are talking about just how bad this is going to be, in many ways are using metrics, or using a model, if you will, that doesn't truly capture what is going on today. Now, I have a few slides to share with you, so I'm going to go ahead and pull those up, and we will talk through these before we go ahead and get to the question and answer period. So let's just go ahead and dig right in. Obviously, what we're dealing with today is already noted, truly a unique circumstance, at least in modern times. We know, of course, up to the first couple months of this year, the global economy had been ticking along. A lot of the fears about a recession had been fading away. Indeed, it's interesting that the large majority of forecasters who contribute to the Wall Street Journal Next Recession forecast in October last year were predicting a recession in 2021 or 2022. But of course, by February of this particular year, that ratio had dropped to a mere 15% for the year 2020. And then, of course, the pandemic, which started in China at the very end of last year, but which was kind of ignored, if you will, by authorities here in the United States, suddenly really took off. And of course, the numbers change on a day-by-day basis. We are truly in the thick of it now. There's over 1.5 million people globally affected. We're approaching 100,000 deaths. And everybody appreciates that we're not at the top yet. The next few weeks, it's going to take a couple more weeks before we get to the top. Now, the key, of course, to the pandemic is that the pandemic itself is not actually harming the economy. Rather, we have unprecedented public health actions across the United States, across the globe, shelter-in-place rules, closure of large swaths of the economy, basically to enforce social distancing, to prevent the ongoing spread of this virus. And of course, you've seen the direct results of that. Over the last few weeks, we've seen 10 million applications for unemployment insurance. In March of this year, the US economy lost 700,000 jobs, and we saw the unemployment rate increase by well over a percentage point. We've never seen this kind of short run, if you will, simply labor losses, as the case may be. But while we're seeing these very dramatic numbers, how bad will the overall damage to the economy be? Now, if you read a lot of the headlines, the answer is a lot of folks out there are talking about really bad outcomes. That is to say, JP Morgan, for example, talking about a 40% contraction in the second quarter, unemployment reaching 20%. We're talking, so the OECD has come out and suggesting that this could be the worst hit to the global economy since the Great Recession. The VIX, of course, which is a measure of financial volatility, is the highest it has ever been, and so on and so forth. People are talking about real estate meltdowns, supply chain meltdowns. It's a very, very scary time. And the doomsayers out there, of course, are out there talking doom. Now, this isn't anything unusual. We have to keep in mind the headlines have been hysterical for any number of years. I want to remind everybody that in January of last year, the stock market was down 20%. And that's because inflation, rising interest rates, the Chinese trade war, and real estate meltdown was going to cause a very bad recession. Of course, as we know since then, none of those things actually took place. And of course, 2019 was a perfectly reasonable year. So we have to take a step back from the hysteria and start thinking a little bit about what is going on and what it does mean for the economy over 2020. Now, here again goes back to some of the grim views. For example, Bank of America and Morgan Stanley on the left-hand side are talking about a situation where for 2 quarters, the second and third quarter of this particular year, the economy is going to be substantially lower than it was in the fourth quarter of last year. And they're not talking about getting back to where we were from an output perspective until, of course, the fourth quarter of next year. This will be a downturn truly unprecedented, substantially worse than the Great Recession from an output perspective. On the right-hand side, a slightly more moderate forecast. This comes from UBS, but even here, they're talking about unemployment at a record high level for the middle part of the year and really not getting back to a normal level yet again until 2021. These folks are talking about a shock that will stay in the system for multiple years. Now, not everybody is that grim. Goldman Sachs, for example, have been forecasting something a little bit more moderate, where we get back to trend somewhere in the middle of 2021. And indeed, by the end of this particular year, we're almost back to where we were at the start of the year. But nevertheless, of course, when you listen to the headlines, clearly it's the negative ones that are taking the spotlight, as the case may be. Now, to understand our view on this and where we're coming from, I want to step back and put a little bit of my professor hat on and talk a little bit about what a recession is. Growth is always the default mode of every economy, and that's because economies are made up of people working to get ahead in life. Whether you're working for your business, for your household, for yourself, we're all striving to do better, and collectively, that means the economy grows. But every once in a while, the system gets thrown into turmoil, and as opposed to growth, we see contraction, and where people are typically able to find jobs, many people aren't able to find jobs. High unemployment, low overall production, of course, a lot of excess capacity. Well, recessions are anomalies, and every recession is a little bit different, but they're all typically driven by a large negative shock to the system. One, of course, that has to happen rapidly and it has to be sustained. By doing so, what ends up happening is the shock can actually create enough disequilibrium that it creates a negative feedback effect. The way to think about this, of course, is to understand that there's always small shocks hitting the economy, whether they're small disasters or the implosion of a particular sector of an economy, so on and so forth. But typically, when resources are removed from a particular sector because of a downturn in demand in that sector, they're easily reabsorbed in other parts of the economy. But once in a while, the shock becomes so large that it sets off a feedback effect. And of course, that feedback effect, what happens is one sector implodes, many people are released. The businesses there simply can't do anything with their productive resources. Those folks and those businesses will go elsewhere in the economy. But if it's a large enough shock, the rest of the economy can absorb those folks, can absorb that business capacity. And as a result of that, we see reduced capacity utilization. That in turn, of course, causes more people to be laid off, which causes further reductions in aggregate demand and creates this sort of negative feedback loop that takes the initial shock and makes it that much worse. Now, the best way of thinking about what a bad recession starts with is to look back at what happened in the Great Recession. Because a lot of folks are comparing what's happening right now, and indeed their forecasts look a lot like the Great Recession. But I can tell you, this is nothing like the Great Recession. And we have to be very, very careful about looking at that episode of the economy and comparing it to what's going on right now. The roots of the Great Recession didn't come in an out of the blue shock the way this pandemic has come out of the blue. Rather, what we're talking about is a buildup of major problems within the economy over the preceding 5 or 6 years. From 2001 to 2007, we saw $15 trillion in borrowing coming out of the financial sector and households. This, of course, driven by the subprime loan aggregation process that allowed really credit standards to be completely dropped by Wall Street, and it pumped a tremendous amount of money into households that really shouldn't have been put into those households. Those in turn created large imbalances in our economy. We were producing too many homes. The housing market was vastly overheated, both in terms of prices as well as borrowing. Of course, all this equity caused Americans to begin to overspend, and we saw that the savings rates dropped substantially, and the trade deficit in the midst of that spending binge widened to 6% of GDP. In 2006, the US economy was not healthy. Yes, growth was good at the surface, but it was rotten to the core, and it was only a function of time before reality started reinserting itself. Well, that all began really in late 2006. That's when the housing market and the lending really started to slow down, and we started to see housing delinquencies start to rise way before the recession actually began. Now, the Great Recession began in December of 2007, and it was an incredibly destructive business cycle. Millions of jobs, of course, were permanently lost in construction, real estate, finance, but then the secondary job losses created by that reduced aggregate demand sent overall unemployment well above 10%. Overall, 8 million jobs were lost in the economy. The recession itself was 6 quarters long, with a 5.5% loss in real GDP, and we didn't get back to normal levels of employment until 2015. It was by far and away the worst recession since the Great Recession. And you can go through some of the numbers here, show how things really started to build up prior to the recession hitting in terms of permits starting to fall in early 2006, delinquencies arising by mid 2006. And of course, you can see that savings rate and that long run decline. Now, if you look at the numbers we've seen over the last couple of weeks for initial claims for unemployment, or here we have insured claims for unemployment, well, in the last 3 weeks of March, first week of April, the numbers have been truly unprecedented. In fact, right now, there are over 7 million people receiving unemployment insurance benefits. That's higher than the peak during the Great Recession. These are truly startling numbers. And it's understandable when you look at this data that you start to think this clearly has to be worse than the Great Recession. But if you look a little closer, something immediately stands out. If you take a look at past cycles, you'll see that unemployment insurance claims don't just jump through the roof. In fact, they're a slow building part of the overall business cycle. Employment is almost always, in fact, always before now, a lagging indicator. Businesses are very reluctant to lay people off. It's an incredibly expensive process, both to let people go and then, of course, later on to rehire people. And it's the last thing they do. It's a last resort. And you see that very clearly. This time around, something completely different is happening. This time around, the economy is starting into this negative hit with a big shock to the unemployment rate. It's completely different. And indeed, it is completely different. This is not a typical business cycle, which comes from a buildup of an imbalance, then a large shock to the system as everything starts to fall apart. This time around, what we are witnessing is a negative shock to the system that's created strictly by spending declines, which in turn are driven by regulatory controls. The hit to the system today are not being caused by some implosion of aggregate demand, but public health mandates that are being put into place in order to prevent the virus from spreading. Now, that's really important. Now, we understand, of course, that there's hits here. Businesses aren't getting their revenues, workers aren't getting their incomes. But then again, that's all being driven by the fact that people aren't spending money. In a very odd sense, there's a balance going on here. People are not spending money and they're not earning money. And it's almost exactly the same number. Now, obviously, are there issues here because you can't simply take a couple of months off. You have fixed costs driven by rents and mortgage payments. And of course, the people who are not spending aren't necessarily the people who are losing incomes. There's some imbalances here. But the way to think about this is very simply is to remember that if we came up with a miracle cure for this virus tomorrow, we can all equally imagine that the mandates will be turned off 2 days ago, and all these jobs that we've seen already removed from the economy would quickly go back into place. And this would become an almost a non-shock. So in a sense, we know that what we're seeing, the optics, these numbers aren't true economic damage. Rather, they're just the short-term results of these public health mandates. Now, the damage that will be done, the damage that's going to continue into the third quarter and fourth quarter, well, that's occurring right now. And that, of course, has to do with the issues having to do with financial shocks to the system, supply chain shocks to the system. But the key here, of course, is that there is no fait accompli. We don't know how this is going to shake out yet. There's lots of different potential outcomes. The most negative one, of course, has to do with the idea that we're going to see a big downturn in the economy that's going to stay in the system for the while. Another potential outcome is we head down, but then we immediately bounce back to long-run trend. But a third potential outcome, if this is very quick, is a big downturn shock now, but that is more than made up for in the context of the rebound if this happens very rapidly. In other words, all the spending that isn't occurring right now occurs a few weeks from now. People don't go to Disneyland now, but they go to Disneyland in June. They don't go out for that fancy meal today, but they go ahead and do it in July. And there's almost a rebound in spending that carries us past that long-run trend before we settle back into long-run trend. The way to think about this is the first one is the Great Recession scenario. The second one's a 1990 very mild downturn scenario. And then the third one is a natural disaster, which really wouldn't be counted as a recession at all, rather just a big bounce in the economy, temporary period of dislocation followed by a huge surge in overall activity, getting back to trend relatively quickly. How bad will it shake out? Well, the big questions to think about are this. How wide and long will this shutdown be? How healthy was the economy? In other words, was this shock hitting a very weak economy that was ready to implode? What is the government doing to intervene? And last but not least, will there be a major shift in post-virus spending patterns? Lots of different questions here, and we don't really have all the answers at this point in time. It's still wait and see mode. So everybody needs to take a step back from panic and realize that there are a lot more questions and answers out there at this particular point in time. So let's go through the how wide and long and where the economy is right now. You know, prior to hitting this shock to the system, the US economy was doing pretty well. In fact, the GDP numbers, GDP Now numbers that come out from the Atlanta Fed suggested the economy was going to be growing in the 2.5% range up until March, when across the United States, we started to see the wholesale placement of these public health mandates, these stay-in-place mandates that have created the situation we're in right now. Now, obviously, the second half of March was very, very ugly. Now, we've taken a look at it. We've tried to replicate, using some of the employment numbers, what's going on in terms of spending inside the economy. It isn't easy, to say the very least. But if you look across different parts of things, and you look at what's happening in terms of the employment numbers, one can suggest that overall, March of this year will see about a 1% decline in GDP. Now, that's enough to offset the gains we saw in January and March, but not by much. In fact, overall, given the last couple of weeks of March, we expected to largely erase the gains we had seen before then, and overall GDP growth for the first quarter of the year will come in at about 0%, plus or minus 0.5%. There's just no way that we're going to see a 5 or 6 or 7% contraction in the first quarter. It doesn't seem reasonable given how late in the quarter this hit. Now, how long will this go? That's another big question. Now, here the answer is becoming a little bit more apparent. Whether we're looking at the number of daily confirmed cases in different parts of the US, you can see very clearly that things have been rising dramatically, but in most parts of the world, we're hitting that second derivative. That is to say, the pace of new cases is starting to peak. Even here in the United States, when the numbers are getting scary, most models suggest within the next week or two, we will hit a peak of cases. And then, of course, it's a function of coming down the other side and getting back to the bottom of things. China, of course, is farthest into this. Behind them is Korea. And in both these cases, 2 months seems to be where the number of new cases gets back to a moderate level. Now, remember, that doesn't mean the economy is going to allow to be turned on again wholesale. But of course, as the number of new cases fall, we'll be able to start to take some measures to allow some things to start restarting again. And of course, that'll help the economy rebound. So we're looking at really a situation by which somewhere in mid-May to late May, you will start to see the economy turn back on again, partially, and in June, almost assuredly, mostly turn back on again. That seems to be what the numbers are at this point in time. And the same thing with deaths. Yet again, you can see a very similar picture in terms of the peak and coming down the other side of things. We can get in control of this thing. It's about a 1/4 shock to the system overall, starting in late March, going somewhere into late May, early June, before, of course, things get back up and running. We don't see this happening going to the third or fourth quarter of the year, as long as we make the right public health decisions right now. Now, of course, that means most of Q2 will be under the stay-in-place rules. And while businesses are still figuring it out, many of them simply are not going to be allowed to operate. Now, again, how do we suss this out? How do we think about where these numbers are going? It's very, very difficult. But right now, our models are suggesting somewhere between a 20 to 25% decline in GDP in the second quarter of the year. That is a scary large number. To put that in context, the worst quarter for growth ever in the last 60 years was a little over 10%. So this more than doubles it. Now, before you get too scared about this, I am using a standard way of presenting these figures, which is to annualize them. Most of the forecasts you're seeing out there are doing the same thing. What this means is that the actual economy is not contracting by 25%. Rather, that's an annualized base of decline. What this really means is that economic output in the second quarter of the year will fall somewhere between 5 and 6% in real terms. That's a big number, don't get me wrong. It's a very, very big number, but it isn't, of course, quite as scary as these numbers we're seeing overall. Now, this real question here isn't, is the second quarter going to be record bad? Of course it is. You just can't with these kind of situations in place. But how fast will the return to normalcy be? Again, the historic model suggests it's going to stay in the system for a while. But you got to understand, all those models are being built around the employment data. That is to say, people are looking at these huge increases in unemployment, and we know unemployment from a statistical standpoint has a lot of momentum. If it's high today, it's very likely to be high tomorrow and stay high for a while. But this isn't that kind of downturn. Remember, in the Great Recession, millions of jobs in construction, real estate, retail, finance were lost permanently. Short of another $15 trillion of lending, those jobs weren't going to come back anytime in the near future. That meant there was a permanent shock to aggregate income. It took years for those workers to get new jobs, new careers, and that created weakness that lasted for years within the economy. That's not the case right now. Today, of course, the economy is fundamentally healthy. There are no jobs that are permanently erased. Rather, it's the short-run turmoil that's going to lead to the damage. So you got to be very careful about using historic cycles to measure this. We know there's some hits. For example, some workers are going to lose wealth while other markets are going to build it. And I don't mean build it from the idea that you're going to make a lot of money with the stock market going down. But remember, a lot of folks who are prohibited from spending are still earning. And of course, that money they're making is simply going to get tucked into savings. There's going to be a huge build in savings in that part of the economy, savings that will come out in the third, fourth quarter. Now, for other folks, particularly folks, say, in the hard-hit restaurant industry, they're going to fall behind. There's no doubt about it. They're going to miss their incomes for a couple of months, but they still have to eat. They still have to pay their bills. They still have to pay their rent eventually. And so they're going to fall behind. The other issue, of course, is will some businesses simply not reopen? Now, yet again, the scare stories are rife out here. So I've heard a story, for example, that 70% of restaurants in the state of California will go bankrupt. But those numbers are based on nothing at all. There's no reason to believe that. Remember, most businesses can handle a 1 month or a 2 month shutdown because of the fact that they simply shut down. Their expenses are gone, their revenues are gone. Yes, they'll lose money for a couple months, but unless they have something else to do, they're going to sit there and wait and hope to be able to reopen their business. And when demand comes back, they should be able to and rehire those workers. There's also financial effects to worry about. Of course, there's a lockdown in the credit markets we all know about. There's a major freak out in the stock market. It's down a tremendous amount. And people are worrying about defaults and loan losses. But yet again, how fast do these things actually kick in? Remember, the problems in the subprime bubble started really in 2006, late 2006, early 2007, but it didn't catch up with the stock market and the financial markets overall until really the second quarter of 2008. So there's a lot of slack in the system, more so than people are thinking. And of course, there are supply chain effects. We understand that if restaurants aren't buying food from their suppliers, those suppliers are suffering. But again, those supply chains, there's elasticity in the system. Businesses that are on the supply chain don't lay off their people immediately. They want to wait to see how things shake out. So there's a little more elasticity in there. Imports and exports, same sort of picture. So yes, we know there's some hits, but how fast they build is still anyone's guess. The good here, of course, is the economy was fundamentally sound when this all happened. Households were in great financial shape. The overall economy is reasonably well balanced. Real estate is rock solid, particularly residential real estate. And the biggest problem we've had in our economy over the last 2 years has been labor shortages. This all suggests that there's more fundamental stability to handle this shock than people would otherwise guess. And of course, let's not forget that government stimulus package. Never has Congress come out with such an aggressive plan so rapidly. We're already talking about 2 trillion plus in spending for this particular year, and they're already talking about expanding that even more. These are huge numbers. To put this into context, remember during the Great Recession, you had a divided government where the Republicans were fighting back against Obama and slowing things down, and we didn't actually have any major fiscal efforts put into place until very late 2008, a year after recession began, 2 years before the hits to the system began. This time around, the help is coming as fast as the shocks to the system are. It's truly unprecedented. So let's go through a few of these numbers here and tell you why I'm comfortable with the health of the economy. Savings rates not at 2%, but rather getting up towards 8%. The financial obligations ratio near an all-time low level. Distributionally, everybody is spending less of their money on debt right now. Yes, high-income households are, so are low-income households. Yes, we're better at 07. We're also better than we were back in 1998. We are not a debt-burdened consumer sector. And as for people struggling to get by, there's been a lot of stories how everybody could barely put food on the table. Not true. In fact, most of the increases in spending over the last couple of years have been in restaurants, recreation, medical products. People have been having fun out there. There certainly hasn't been a lot of sign of distress. Labor markets have been incredibly tight with unemployment at a record low 50-year level. For the last 2 years, there have been more job openings than people looking for work. In other words, there are a lot of space out there to absorb people on the other side of this thing. It doesn't seem like a lot of people are necessarily going to be out of work for long. Very few discouraged workers out there. In fact, the U6 unemployment at a record low level. And yes, wages have been rising over the last couple of years for most workers in real terms, once you look at the data right. This is not a delicate economy. This is a very, very strong economy. Same thing with residential real estate. We've heard something on the order of 15 million potential foreclosures. But why? Because the numbers look bad and from an employment standpoint? No. You got to think about the fundamentals of real estate. For example, there was a little bit of a slowdown in sales, but it's picked up. Prices are nice and steady. Because of Dodd-Frank, mortgage originations, the mortgage market, from basically a credit standard perspective, the cleanest we've ever seen it. Equity share of residential real estate at a record high level because of low pace of mortgage borrowing. This is not a delicate housing sector. It's not going to implode. Even how much people are spending on housing, whether it's rental or income as a share of their income, the share of housing cost constrained households out there is the lowest it's been in a decade. This is not a fragile economy. How about the broader economy? What about the business sectors? We hear a lot about corporate debt. Yes, corporate debt is non-financial corporate debt as a percent of GDP is at an all-time record high, but only slightly. And by the way, financial debt, consumer debt, non-corporate debt as a percent of GDP, these are all lower than there was a few years ago. And if you look at overall delinquencies and bank lending, again, record low levels across the board. This has been a very, very clean credit market, certainly not one that's going to implode simply on the basis of a 2 or 3 month shock. It really isn't. And I don't, candidly, this panic seems to be more about getting headlines than actually, if you will, having a realistic conversation about where things are. And you can even say that about credit card delinquencies and bankruptcies. Again, not a stressed economy. And then as noted, government policy. And here, there's all sorts of policies. We'll just take 2 minutes to talk about the CARES Act. $550 billion in payments to American households. $300 billion is in terms of these direct payments to American households. $1,200 per individual, $2,400 for a married household, and extra money for kids. $250 billion for expanding the unemployment insurance benefits. Not only have they expanded the unemployment insurance program to cover many more people than it has in the past, hence those huge numbers in initial claims, the conditions have shifted, but they're expanding those benefits. And indeed, the maximum you can now get is about $900 per week, which, by the way, is the median income for an American full-time worker right now. So yet again, the numbers suggest a lot of give back to households. Small businesses will get 400 to 600 billion in loans. Some of this will be forgivable. Other businesses, $500 billion in economic stabilization in terms of direct subsidies and loans going to airlines, companies that are considered to be important for national security, financial stabilization, and of course the government support. 350 billion to local governments, hospitals, airports, public transit systems, a huge amount of help going out there to stabilize the situation. And it isn't just the federal government. States and the IRS are delaying tax payments in the second quarter. We all had that money going on. Local governments, of course, are putting moratoriums on evictions to slow that process down. A lot of large landlords are doing that themselves. The Irvine Company, for example, recently announced that all the retail tenants don't have to pay their rent for the next 3 months. They have to pay it by the end of the year, but not for the next 3 months. Mortgage holders, the public mortgage holders, Fannie, Freddie, are allowing people to defer paying their mortgage for a couple of months. Food programs are expanding. It's a truly historic level. And of course, the Federal Reserve had already been cutting rates. They've gotten even more aggressive over the course of the last couple of weeks. Really, honestly, an amazing amount. $2.3 trillion in loan to calm financial markets down. They, of course, are going to be running the Paycheck Protection Program, which is loans to small businesses. Unbelievable, the amount of money flowing into the system right now. Take, for example, hopefully I haven't frozen, but no, there we go. Okay. Again, take, for example, just the overall the $800 billion going into $550 billion going to American households. That is almost equivalent to the amount of lost income we're likely to see in the second quarter of the year. Truly, truly amazing numbers. So if all this is good news, why are the stock markets freaking out? Well, the answer there is the stock markets have been consistently freaking out for a decade, both in terms of the positive and the negative. We all have to remember, we started with the pandemic with the stock market clearly in a bubble with a PE ratio of 31-1. And some of this is that bubble bursting. But of course, remember, this is the 7th time the stock market has sold off since the Great Recession came to an end. We've never seen this many major sell-offs in the stock market in such a short period of time. Clearly, the stock market is excessively volatile. It is a problem. It's a problem for the short run. It's a problem for the long run health of the U.S. economy. Incredibly important system for people to invest, for companies to raise money, seems to be broken, not in terms of the value of owning corporations or the ability for these corporations to make money, but in terms of the valuation process is driven largely by high-speed trading. Yes, it's a conversation we need to have, but of course what it means right now is you can't look at the stock market as a reliable indicator for just what's happening in the economy. You have pension to all these things. So let's go ahead and wrap it up. Then versus now, the Great Recession versus today. Then, millions of jobs lost. Today, millions of jobs temporarily furloughed. Back then, financial system pushed to the edge of collapse by, of course, the massive losses built up after $15 trillion subprime lending asset bubble. Today, the financial markets look rock solid. Back then, consumer spending was severely hit as people had to rebuild their balance sheets. Today, people's balance sheets are in great shape. This is not the Great Recession. Now, again, we're still trying to figure it all out. How long does this last? Does it get into the supply chains? Does it start creating secondary cascade effects? How long for the credit impairment to start actually becoming significant? Is it 2 months, 3 months, 4 months? We just don't know. But again, panic is not the appropriate thing. So here's a couple thoughts, a couple worries for me. First of all, there are a lot of folks out there who are talking about the cure being worse than the disease. This idea that the efforts to combat this virus are worse than the virus's impact on society, that's just wrong. We have to remember, the idea here is to shrink the number of cases and make the duration shorter. If you don't do this, if this thing does get out of control, millions and millions of people will die across the globe, and it will truly create a global recession as we have to shut down the economy even longer to get in charge of it then. Better to do it now. Nip it in the bud. Use whatever cliche you want. A stitch in time saves 9. Do not back off these efforts. Do not be afraid of the impact on the economy. We can bounce back yet. The other thing to think about is, isn't it sad we were already lined up to borrow $1 trillion this year? You know, it's good that the federal government's getting involved, but we're going to go from $1 trillion to $3 trillion in borrowing this year. As a percent of GDP, not only is that significantly larger than under the Obama administration, it's larger than it was under World War II. So we're talking about a federal government that's rapidly approaching a major fiscal crisis, one that's going to happen within a decade, and seem to be inclined to bring it closer to us. You know, if we had some fiscal responsibility at the federal level, this would have been a much better way of dealing with the situation. Sadly, we didn't. And of course, we are generating even more long-run problems. It's good they're doing the things they're doing right now, but remember, all this money will have to be paid back at some point in time. So looking ahead, what's our baseline forecast? Well, wrap it up, 0% for Q1, negative 25% for Q2, a positive 20% for Q3, 5% Q4, basically bringing us back at the end of the year to where we were at the beginning. Overall unemployment, probably back below 5% by the very end of this year. Yeah, we look for a very, very nasty first half, a very aggressive second half of the year, and overall growth this year, which should have been about 2%, will be 0%. So we've still lost. There's no doubt about it. There's still a hit. But this is very, very mild. And in fact, some folks might even question whether or not it's technically a recession. You know, you need a longer period of negativity to call it a recession. I'm not sure this qualifies, but that's an academic debate. No doubt Q2 is going to be one of the ugliest things ever, but we're looking for a rapid bounce back. Obviously, some minor uptick in debt distress, stock market, who knows? But of course, overall, little impact on venture capital and of course, real estate. We just don't see that having that kind of effect. Businesses should look beyond this, understand there absolutely is going to be an economy when this virus is put under control. Now, with all this in mind, there are wild cards out there. Could there be a second round of outbreaks and shutdowns? Possibly. The global situation, man, if this thing gets into a lot of developing countries like India and Africa, there could be disruptions in global supply chains that could have some effect even on our relatively insulated US economy. We know the shakeout in retail and restaurants is going to be real because these sectors were already under a lot of distress. Retail because of the internet, restaurants because of oversupply. I'm also worried about financial markets. Not that I think that they're under risk, but the panic and excessive volatility can in its own right create a crisis. That's not good. The financial market is supposed to be a buffer to risk. Instead, it's becoming a risk in its own right. It's time for regulators to wake up and take a good hard look at what's going on in Wall Street in order to make finance what it's supposed to be, a shock absorber, not a shock increaser. And of course, last but not least, there is the big question, one that almost no one knows how to answer, which is what are consumers actually going to do? Now, I believe that consumers are pretty resilient, and I think people are going to go back to doing what they were doing before pretty quickly. People don't take a big hit. It takes a lot for habits to change. But seniors, other folks, they might truly shy away from things like football stadiums and theaters. And there may be some shakeout because of that. It's just wait and see. We just don't know. Here's what I do know. The US economy started this in one of the fundamentally most sound positions it's been in 30 years. It's not a fragile economy. We can take a hit. And if the government's doing what it needs to do and we work with each other, we should be able to bounce back really quite rapidly. There's no doubt about it. I'm very hopeful, and I hope you are too. But with that in mind, a couple quotes. Remember, a good forecaster is not smarter than everybody else. He merely organizes his ignorance a little better. And of course, a forecaster is an expert who knows tomorrow why the things he predicted yesterday didn't happen today. It's a risky business. What I do know is there's a lot of uncertainty, something we have to pay attention to. But this idea that this is going to be the worst downturn ever, there's absolutely no certainty of that. And I'm hopeful that it will not happen. And I hope you are too. Thank you very much, Dovi. Back to you.
All right. Wow. That was quite encouraging. Thank you, Chris. So I have a bunch of questions from the audience, but we'll make it interesting, and I'll let you choose the topic. Okay, so I'll shoot a few things, and you'll just choose one. Okay, and we'll start with that. So the role of the media, number one. Number two, the role of our government and potential future inflation. Third question was around unemployment, and will large employers take advantage of this situation to become more efficient and deal with their unions and stuff like that, and how it will affect unemployment. Next question is trade with China. Okay, nationalism. Next question after that was digital transformation going forward. You just choose one. Next.
Oh, well, let's just start. Let's just pick one. Just start. What was the first one? Give me the first one again.
Yeah, you know what? Let's start with something that is a little bit fun. Let's start with the role of the media in this crisis.
Yeah. Okay. Great. Love it. So look, the role of the media has been obviously to expand the panic, and that's typical. I mean, look, as noted, if you went back a year and a couple of months ago, everywhere you looked were headlines about the recession that was going to happen. There's nothing particularly unusual about hysteria in the headlines, right? And we need to factor that into our thinking. You can't read this stuff in this world and just assume it's true. Rather, the headlines seem to be largely about everybody trying to get attention. So everybody takes the most negative viewpoint possible. One of my favorite headlines lately was there was 1,000% increase in forbearances in the public mortgage companies, right? Like Fannie and Freddie, 1,000%. Now, by the way, a forbearance is a voluntary delay in mortgage payments, and a lot of people took it. Hey, why not, right? But of course, to be clear, 1,000%, we went from 0.2% to a little over 2%. In other words, it's a tiny share of outstanding mortgages. We have to stop trying to twist everything to make it sound as negative as possible. Now, people should be smarter about that, but I tell you, so should our policymakers. One of the things that worries me the most is when you start hearing President Trump, talking about backing off these restrictions too early. That could truly create a crisis where one doesn't mean to exist. We need to continue what we're doing. We need to listen to our health folks. We need to stay in place, wear our masks, stay away from each other. Let this thing ride out, because the harm to the economy doesn't have to be anywhere on the internet. Negative. Simple as that.
All right.
So the other thing that's interesting about this, yet again, go back to this idea of this massive program being put into place by Congress. Well, that again is driven by the panic, driven in turns by the media. Congress is panicked because this is an election year. And you know, it's going to be very interesting looking back at this package and asking ourselves, what actually worked and what was a complete waste of money? Because I tell you, not all this stuff is actually necessary. A lot of it's nothing more than basic pork. And again, we're going to have to pay this back someday.
Right. So speaking of which, actually, that would lead me to the next question.
Yeah.
Because there unprecedented amounts of money were packaged nicely and sent as a stimulus bill into the floor of Congress, were approved. We're seeing more of that coming. Yeah. What do you think about inflation going forward?
Well, inflation, of course, is a function of money supply. And right now, the Federal Reserve is trying to deal with a lack of money supply, right? Everybody's getting scared. They're hoarding cash. You start to see short-run issues within that short-run credit market. And the Federal Reserve is doing their job. They're getting in there. They're buying every short-run security in sight because they want to keep those financial markets flowing. Now, yes, that pumps a lot of cash into the system. But remember, that cash from an inflation standpoint is offset by the enormous increase in cash holdings by businesses and individuals. So in a sense, it becomes inflation neutral at some level, not unlike quantitative easing was inflation neutral as well. Now, ultimately, we are going to have a big federal debt problem. Again, we're running towards that. And at some point in time in the future, we're going to figure out how to pay it back. Now, that can be through increased taxes, which is going to be a problem, or equivalently, it can happen through, of course, basically expanding the money supply. That's why we have an independent Federal Reserve. So no, inflation is not a risk here. In fact, if anything, over the next few months, you could expect prices to come down pretty sharply, which will be a little bit of a boost to the economy. For example, anybody thinking about buying a car, there's some great deals out there right now.
4 months, don't pay anything. Just
So,
take the
yeah,
freaking car from the.
exactly.
All right, let's talk about unemployment. I
Yeah.
asked you when we were starting this thing.
Yeah.
Do you think we're going to see? Well, I read through your slides, obviously, that
Yeah.
you believe that unemployment will bounce back, will be at around 5% by the end of the year. But do you think large employers will take advantage of the opportunity to deal with their unions finally and lay off some people in an effort to become far more efficient?
Yeah, no. Look, unions have a lot of power right now. It takes a while for them to really, it takes bankruptcies to get unions to particularly stuff like the auto sector, for example. It took the bankruptcy of GM to get them to really come to the table and do things. So I don't actually see a lot of shift on that particular front. This is simply too short of an episode. And we got to remember, when we came into this, the nation was dealing with labor shortages. Yeah, I get it. Some companies, some sectors probably had a bit of an excess supply. But take, for example, Disney. You know, Disney announced that they were going to continue to pay a lot of their furloughed workers right through this crisis, at least for the first month, if not more. Now, why would Disney do that? Well, it isn't because Disney's a nice company. Disney is a profit-making machine, as we all know. But however, take a look at, say, Disneyland in Orange County. Orange County has a 2% unemployment rate. The biggest problem Disneyland is having, in fact, most of the hotels and restaurants around Disneyland are having, has been trying to hire people. So in a sense, a lot of companies, smart companies, are going to recognize you're not going to just lay people off willy-nilly. Yeah, you might have to furlough them temporarily. After all, better to have your workers go get that $900 a week unemployment insurance than necessarily you having to pay them out of your own pocketbook if those systems are there and available. But at the same time, I'm sure they're telling their folks, as soon as this thing's over, we're bringing you back. So you don't want to go ahead and simply get rid of your folks, not right now, not in this labor market, not with a lack of folks. There's going to be some dislocation here and there. There's no doubt about it. Remember, if we get back to 5%, that's still a percentage and a half point above where we were before this crisis began. That's not an unsubstantial increase. But overall, in a labor supply constrained nation, a lot of workers should be hoarding, a lot of companies should be hoarding their workers, not letting them go.
Got it. Also, you mentioned to me in the past, and I think that's a valid point, that many of the people who were laid off or sent home on an unpaid leave actually they're not considered trained employees, right? So they're easier to bounce back into the workforce, working at restaurants and stuff like that. Okay.
That's true, and to be clear, but they're also, if you will, the folks who are most at risk of all sorts of financial calamity when they're cut off from their income for a couple of months. In a sense, that is almost more of a social catastrophe than an economic catastrophe. And we have to deal with that through various sorts of social support mechanisms. Good news is we have a fairly strong safety net, one that's been increased by, of course, the CARES program.
Got it. My chat box is exploding with questions around real estate and the future of real estate and how, how landlords should behave right now because they're going through tenants who basically are not paying their leases, commercial and residential alike.
Right. Well, if you're a smart landlord, the answer is let them not pay. Look, the commercial markets are not brittle, right? People have leases, commercial markets, you think labor markets lag, commercial markets lag like crazy. The argument here is you're penny wise and pound foolish if you start pushing on your tenants that hard. Because if you push on them, if you cause them to close, then guess what? You're going to have an empty spot there in 4 months. Better to work with them. Obviously some forbearance, probably a little bit of forgiveness. But ultimately, better to keep those businesses in place, help them get back up and running as we get to the end of the year. The system has slack. The idea that 2 months of not paying rent is going to cause the financial system to simply implode, that's ridiculous, particularly in this day and age.
Interesting. So you're saying that the lenders, because every landlord has a lender, right? Obviously,
Yeah.
especially commercial real estate. So you're saying that the lenders will also take the time, right, before they move towards foreclosure, right? Because
They have to.
right,
Look, it takes months to move through the foreclosure system. And
9
by the
months
way,
right
to be
now.
clear, the legal system shut down too, which is going to make it even longer. So even trying to foreclose is going to be incredibly complicated at this particular point in time. Look, we're all going to have to sit on our hands for a couple months. And then when the dust clears and we get back up and running, then we can start taking stock of what the true ramifications are. Yes, we're all going to take a profit hit this second quarter of the year. It's just part of it. It's part of the process. But again, with a fundamentally strong economy, with economy at the end of the year, which should look basically like the economy at the start of the year, there's no reason that this is anything more than just that, a couple month profit hit.
Right. Let's talk about recovery for a second. During your session, you mentioned, you actually said, I wrote it down, with taking the right public measures, right?
Yeah.
Getting back.
Maybe too many public measures, right? Maybe even overboard. But hey, better too much than not enough, right?
So let's talk about that. You're seeing different countries respond differently. We actually just saw Singapore closed again, right? After they opened up for work. And we just heard Justin Trudeau yesterday, I think, or 2 days ago, saying it's going to take many, many more weeks before Canada gets back to work. How do you envision the Americas going back to work over the next few months?
Well, again, two things are going to happen here, right? First of all, as cases come down, we are obviously going to start allowing some things to start happening. Not everything, right? We know that certain types of events are just not feasible at this point in time, but other things are going to be certainly allowed to happen. The other thing to keep in mind is that people don't sit around like deer in the headlight. People mitigate. And you already have businesses trying to figure out, how do I operate? How do I move forward? How do I continue to do what I need to do in this particular environment? And we're going to learn, and we're going to get better at it. And of course, what that means is, even in the context of the next few weeks when we are shut down, we're going to see some modest returns to normalcy. And remember, there's going to be a lot of shift in spending. A lot of restaurants aren't seeing any kind of increases, and obviously you're seeing big declines in revenues. But some of them, of course, are doing takeout. And I tell you what, boy, other parts of retail, Amazon is going crazy. You think Jeff Bezos was rich before. After this, he's going to be shopping for whatever developed nation he wants to buy. He's thinking either Netherlands or perhaps Switzerland. He's not quite sure yet which one he's going to buy. But you can see where we're at here, right? There's big shifts inside the economy, and you're going to see a little bit of growth that's going to help, yet again, keep those supply chains moving as we go ahead and move through the system.
So let's elaborate on that for a little bit.
Yeah.
So the GDP is comprised of many pieces. Obviously, government spending is a big part of GDP, healthcare as well. So let's talk about which portions of the GDP will bounce back or have already bounced back quicker than the others, and just try to draw it for us, if you will.
Well, look, some parts of GDP, of course, are going to continue normally. If you kind of broke it down, think about professional services, they're going to flatline a little bit, but they're certainly not going to implode. Most professional businesses have skilled people. Their skilled people are working from home. Finance is busy. The big shocks to the system right now, at least what we've seen without any supply chain effects, obviously recreation, hospitality, absolutely pummeled. That's about 7% of the economy overall. Interestingly enough, the second hardest hit sector of the economy, at least from a job perspective, is healthcare. Now, that surprises a lot of people, but remember, a lot of healthcare is actually discretionary, whether it's dentists or eye doctors. These have largely been shut down because they're bad sources of transmission. Number three, of course, some personal care services, thinking of barbers and stuff like that. That's about it. Mm-hmm. Everything else seems to be operating. They're not adding, they're certainly not growing, but they're maintaining. And I think that's the important thing there, to maintain. And as a result of that, some general weaknesses, but the big thing, of course, is consumer spending, particularly on travel, accommodation, restaurants, recreation, those sectors that are really front and center in terms of the things that are happening out there right now.
So let's talk about the travel industry, hospitality,
Yeah.
airports, etc., which you said count to about 7% of our GDP altogether. Um, and of course, employ about 11.4 million people throughout the states. How do you envision their return to normalcy, where we have an epicenter that is basically a moving target across all 50 states?
Yeah. Well, look, that's the key, right? A lot of this is going to have to be just local. And to be clear, when we come out of this, it's not like the virus is going to be gone. We know we're going to have to be hyper vigilant. The CDC is going to have basically healthcare SWAT teams roaming the nation, constantly scrubbing for any kind of hotspots flaring up. And there's going to be some mini shutdowns. This doesn't go away by itself just that quickly. However, yet again, we're going to mitigate. We're going to learn how to do things in a way that reduces the risk as much as possible. And as such, of course, I think we will get back to work relatively quickly. Where are you going to see lagging effects? Well, airlines almost assuredly are going to take a big hit. They took a big hit after September 11th. Now, again, they're getting direct money from the federal government. They're going to have to cut down their capacity pretty sharply, to say the least. But business is business, and they're going to continue to operate at some level. They will muddle through. Again, it's just not a big part of the economy. Hotels, similar sort of thing. They're going to take a big hit. People aren't going to travel immediately after this. But unlike airlines, I don't think they're necessarily going to see a complete collapse in overall demand for them. They're going to be muddling along just on the basis of necessary travel, as the case may be. I'm trying to think some other parts of the economy that may not come back quite as rapidly.
Yeah.
Well, anyway.
Yeah. What do you think of that? Let me make it a little bit more difficult for you.
It's getting harder as we go along, by the way.
I'm not sure I'm buying into the, and again, I'm wondering what is your opinion without kind of like setting my own agenda here. But do you believe in the work from home thing? Like no. I keep reading news where work from home is a new world order, and this is basically our future. We're going to sit with our underwear at home and with a digital background behind us, and we're not going to fly. We're not going to conduct business. We're not going to travel as extensively as before. How exactly are you seeing it?
Well, again, whenever we have these kind of unusual episodes, it immediately leads to these kind of sweeping statements. Things will never be the same. And again, I think we've all said that ourselves. We've all said exactly the same thing on a Sunday morning after a particularly late Saturday night. Things will never be the same. And yet somehow or other, a week later, we're out at the bar again. People's habits die hard. And yeah, I do think we're going to find some efficiencies here. We're going to find that maybe we don't necessarily have to get on a plane all the time. Certainly, we all appreciate Zoom and how this system here has in many ways given us the ability to have conversations like this. But I will tell you this, why I appreciate sitting here chatting with you, Dovi. I much prefer being in front of a crowd of 100 people or 20 people having this conversation where the audience can talk to me and I can talk to them. It's more enjoyable. It's more networking. It's ability to build relationships that are offline. While people may be able to work from home, we all know that being around other workers makes you more productive, not only from basically keeping you focused on your work, but just the ability to interact with other workers. And I can tell you, the last thing here I think everybody has to keep in mind is after being at home for 3, 4, 5 weeks, I think we're all ready to get the hell out of the house. So I don't think it's going to be anywhere near quite as dramatic as people think. Probably the biggest thing of all may be really in that retail space, because a lot of people who maybe weren't still buying everything from online sources may just start doing so because they've realized just how easy it is. That may accelerate, if you will, the shift from brick and mortar to online. But it's a little too early to call the end of the world on that particular front.
Definitely. I definitely, we've been talking for a long time, and whoever wants to read, I have it on my Medium post and LinkedIn, talking about man-machine symbiosis and digital transformation. And obviously we invest in those type of software companies. And we've been seeing, and it's kind of surprising, over the past couple of months, an accelerated pace of prospective customers approaching companies like TripActions, like Tipalti, basically trying to check out what they're doing because they're trying to reduce expenditures at this time and become more efficient. So definitely happening there. Let's talk a bit about China, if you don't mind.
Sure.
Let's talk about trade with China. And how do you foresee the tariffs that were imposed and the future of the trade with China, given that many people in the Americas attribute this crisis to China?
Well, yeah. I mean, look, obviously the relationship between China and the United States was already stressed before this thing happened. This certainly hasn't helped much. And candidly, we really don't know what's happening in China right now. We have some decent numbers in some small circumstance, but it seems pretty clear that they're understating what's truly going on over there. But with that in mind, indications are their economy is starting to move again. They're still below where they were when the virus hit there. But really, over the last couple of weeks, things are slowly but surely getting up to normal. It's a great example for how we think things might happen here inside the United States in terms of that bounce back that may occur over 4 or 5 weeks. Again, terrible second quarter, big bounce in the third quarter, and all that we just have to keep an eye on China leading us forward. But from a long run standpoint, which is where I think you're going, how does this whole thing shake out between the relationship between the United States and China? There could have been an era of cooperation, but of course it's turned yet again into acrimony and dispute. There's a lot of finger pointing going on. Certainly the Trump administration has been trying to really pin, if you will, the blame for everything that's going on China, rightly or wrongly. And this is built on top, of course, those tariffs. Now, the tariffs, to be clear, had almost no impact on the U.S. economy. And that's because the Chinese recognize that ultimately, when it comes to trade with the United States really does have the upper hand. It's like the old expression, right? That if you own the bank $1 million, the bank owns you. If you owe the bank $100 million, you own the bank. Well, that's the same thing in terms of the United States and China. We're such a big client of theirs. Exports from China to the United States, it's 4% of their GDP. You throw in supply chain effects, and it's pretty clear they are remarkably dependent on us. So when it really came into this, we know that China allowed the yuan to depreciate simply because of the fact that they had to maintain volume. What happened here in the United States is we started shifting to other sources. You saw a big sharp decline in both imports from China, exports to China, when we started sourcing those imports and exports to other parts of the world. And ultimately, really trade didn't fall that much. The U.S. really was working through it pretty well. Now, when we get out of this, the real question is where our relations with China and the United States going to be, and how do we see this moving forward? Well, again, I think you're going to see even more decoupling between China and the United States. Now, I actually honestly think ultimately this is good. It's good because China has been getting a little aggressive. A lot of their policies over the last few years have not been fair to the global economy, and it's really time that they start pulling back and playing fair, and only the United States can force that. In the meantime, American companies have realized you can't be this dependent on a country like China, not only because of the trade issues, but because of the virus issue. You really have to have a portfolio of suppliers across the globe. Now, right now, they're looking around and wondering where those portfolio are going to be. They're probably going to end up being relying on China because that China is going to be the first country to come out of this, at least in the short run. But again, as the year goes on, I think what you're going to find is there will be a longer term effect in China than maybe in the United States. in part because the rest of the world's going to be a little wary about working with China after this episode.
Yes. All right, Doctor, that was great. Such an amazing session. Really appreciate your time today. And with that, I think we'll conclude the session. Thank you, everybody, for joining. And we'll provide the recording of this session on our website. I'm sure Chris will do it on his website as well, on Beacon Economics website. We'll do it on group11.vc. And with that, we'll conclude. Thank you, everybody.